My name is Andrew Schwartz. I'm partners with my brother Rick Schwartz in the CPA firm of Schwartz & Schwartz. We're based here in Woburn, Massachusetts, just north of Boston. Each winter, we prepare tax returns for about 2,500 physicians, dentists, and psychologists. So we're very familiar with the tax issues affecting healthcare professionals. We also work with about 400 one and two owner medical and dental practices, mostly in the Massachusetts area. So it's just, we're familiar with the issues affecting them as well. So it's a focus of our practice. And I've been doing this presentation for the last few years, and we think it goes pretty good. So here's what we're going to go over today. One second. Next. Okay. So here's the agenda for today's meeting. We're going to start out with a quick reminder about PPP loans. COVID started about 3 years ago, and it's all coming to an end, all the subsidies and reporting on the subsidies and all that. We'll also talk about common deductions available to locums. We will discuss retirement accounts and why they're so important while you're in your working years. We will discuss the very great health savings account as a way to provide health insurance for yourself and also to save some money in tax advantage accounts. We'll talk about paying quarterlies, the QBI rules. We'll go over some planning tips. And then this year I added a couple of slides for state tax concepts and also a slide on S corporations, because that seems to be a common question. So I do have the Zoom, whatever, the ribbon open there. So if someone does have a question that has to do with what I'm talking about, maybe I'll try to answer it if it comes up and it's relevant, but if not, we'll get to it at the end. All righty, so let's get right into it. Okay, so the first issue I want to discuss has to do with PPP loans. So COVID started March of 2020. There was a lot of concern about how people were going to pay their bills if they weren't able to work. The government did what they needed to do to keep small businesses in business, which was great. There were 2 rounds of the PPP. Everything is pretty much all done. The money has all been dispersed. All the forgiveness applications should have been taken care of. People shouldn't have to pay back the PPP money that they gotten. The amount they can get if they were the only employee of their practice or of their business is $20,833 per round. The point I want to make is, and I've seen this with a few tax returns for preparers that were not with my firm. Hopefully we didn't make this mistake as well. I saw it where the tax return was filed and the tax-free PPP forgiveness was picked up as taxable income. So if someone just grabs a set of books, the PPP forgiveness, the amount that was forgiven, does show up as income on the profit and loss report. And whoever's doing the tax return has to have the wherewithal to not pick it up as income and report it a very certain way on the tax return for 2020 or 2021, whichever year, probably 2021, whichever year the PPP was forgiven. So when you're doing your tax return this year, take out your last year's tax return and just make sure that you're 100% certain that whoever prepared your tax return didn't pick up the PPP loan forgiveness as taxable income to you. And if they did, you're going to want to amend your tax returns and you probably get back $8,000 or $9,000 worth of taxes. Okay, the loan forgiveness is not taxable. If you're self-employed, and the $20,833 that you got pretty much went to your salary. Okay, so the next topic that we're going to discuss is deductions. So when you work as a locum tenens, you get paid as a 1099 contractor. So you do the work and you get paid a 1099, which as a 1099 contractor, so you get a straight check. You don't get paid as a W-2 employee. You get paid a straight check. And that means that you're allowed to deduct your professional expenses against that income. The underlying principle of deducting business expenses is very simple. For an expense to be deductible, it needs to be both ordinary and necessary in connection with your profession. One second, there is a question. So the first question is, what is the PPP loan? Oh, sorry. The PPP loan is the Paycheck Protection Program that came out in March of 2020 when COVID started. And it was a loan that anybody who had a business that had employees was able to apply for this forgivable loan that provided them with funds so they can get through COVID when they weren't able to work because everybody was at home for 5 or 6 weeks or for whatever period of time. Okay, so so for a professional expense to be deductible, an expense to be deductible must be both ordinary and necessary in connection with your profession. If you buy a laptop to keep track of your time and to keep track of things while you're at work, I would say that counts as ordinary and necessary. If you get a nice, expensive Coach or Gucci carrying case for your laptop, that you might think that's ordinary and necessary, but I'm not sure that the IRS would agree. And also, any expenses that are reimbursed to you by the Locum Tenens company or by anybody else aren't deductible. Whoever makes the reimbursement to you, they're the ones who would be deducting that expense. Okay, and what we're going to go over is some common deductible expenses, including health insurance, which is deductible a little bit differently, but that is deductible. We're going to talk about travel, lodging, and meals, automobile expenses, education, licenses, and examinations. And then here's another relic of the COVID era, this 139 reimbursement, which was very important in 2020 and somewhat in 2021. It actually isn't relevant again. It's not relevant anymore in 2022. And let's take a look at some of these deductions right now. So first off, how are we doing here? Okay, health insurance. So if you're working as a locum tenens and you do not have access to health insurance from any other source, you don't have access through your spouse's employer, you don't work somewhere that has insurance, you're not getting health insurance as a benefit as a retiree of an organization. If you're paying your own health insurance and you're self-employed as a 1099 contractor, the first thing that you can deduct is 100% of your health insurance premiums. So that's a big deal. Health insurance is very expensive. It's very important to get. And the fact that someone who is self-employed can deduct their health insurance premiums, it helps make the health insurance more affordable. If anybody's doing locum tenens and they're 65 or older and they're participating in Medicare, the Medicare premiums that they pay either through Medicare, either directly to Medicare or by coming out of your Social Security benefit, those Medicare premiums count. They count as self-employed health insurance. Okay, so anybody who is doing locum tenens, paying health insurance either on their own or through Medicare, make sure to deduct those premiums directly against the locum tenens income. Or if you're working and you're working as a sole proprietor, you did not set up to be an S corporation, you would deduct 100% of your health insurance premiums, but you take it in a little bit different location on your tax return, and whoever does your tax return would know exactly where to put it. I want to point out that you cannot deduct your health insurance premiums if your spouse has access to health insurance through his or her job, or one of your employers offers the insurance. Even if you opt out, you are not allowed to claim the health insurance deduction. So if you have access to it, but you'd rather buy your own policy, that doesn't make it tax deductible. I see a bunch of questions came in. It's going to be difficult to keep up with these. So I will get to the questions at the end of the presentation. So keep asking them and we will definitely get to them. Okay, next up, we have travel, lodging, and meals. So this is actually a big one for anybody who's doing locum tenens work. One of the benefits of doing locum tenens work is you get to travel all over the country, or I guess the world, and go to different places and work and live somewhere for a while and really have a very worthwhile experience of working with people that maybe are, have different backgrounds, and then also living in other parts of the country or the world. Okay, so anytime that you work and you travel somewhere for a period of a year or less with the intent of returning back to where you were living and working before you started that position, that time that you're working away from your home, it's treated as one long business trip. And what's deductible in this situation is all the travel expenses all the lodging expenses you incur, and 100% of the cost of the meals, or there's a second way to figure out the cost of the meals. All right, so travel and lodging expenses are based on actual expenses incurred, so it's what you really pay. And the meals, there's two ways to calculate it. We'll talk about that in a second. Any expenses that are reimbursed, like I said before, for travel and lodging and meals, you can't deduct against your locum tenens income. But otherwise, it's fully deductible. And you want to keep good track of those expenses. For your meals, there's two ways for you to deduct the cost of your meals. And when you make your choice, you need to be consistent of how you keep track of your meals by trip. So not by day and not for the whole year, but by each trip. And one way you can deduct your meals is just save all your receipts. You save all your receipts, you base your deduction on the actual cost of the meals incurred, and that's your deduction. The other way is using this thing called per diem rates. So here, the government actually did something where they made our life easier, and they basically said, if you're on a business trip, you get to claim your deduction based on a daily rate for each city, and we're going to go show you how you can find what the daily rate is, and you just multiply that daily rate by the number of days you are on your locum. That is your deduction. So, so at this website, www.gsa.gov, we click on this and we scroll down. Basically, we can put in any location, and they can and they'll tell you how much of a deduction we get. So if we put in, let's say you went to New Orleans, let's just put in this. With search, and we did it for 2022, and we search. So it's going to give us all the daily rates for New Orleans. So if we went to for Louisiana, so if we went to New Orleans, here's the daily rate that you get to deduct for food, which is very high. Wait, that's daily lodging. Here we go. Sorry about that. New Orleans, the daily rate for food is $74. It's meals and incidentals. So $74 per day times the number of days that you're on your trip, doing your locum tenens. That's the amount that you can claim for your meals. So that's definitely very simple. We don't want to do a survey. Okay, very simple. Most of the clients that I do taxes for, they don't keep track of their receipts for each of their meals. They usually find that they're better off basing the deduction on their per diem rates. And we just go to this website, we find the locality, and we multiply it by the number of days. And if somebody does foreign travel, then here's a website right here for the foreign travel. And I think this pops right up. Okay, so you just look right there. Nice and simple. How do you like that? The government made something simpler for us. Okay, let's talk about automobile expenses. So let's say you go on you're assigned to go somewhere, and it's close enough that you can drive. Now the rules, and this applies to travel and lodging as well. I forgot to mention this. One of the rules is for travel to be deductible, you have to go far enough from where you live that you wouldn't be able to return later that day without first sleeping. Okay, so travel is deductible if it's outside of the metropolitan area where you live. It has to be far enough away that you need to rest before returning home. Now, for your automobile expenses, that same rule applies, or we can take it a step further. So what's deductible for mileage is this: driving between job sites, driving between your home and a temporary job site. And a temporary job site is a job assignment that you have that is expected to last for a year or less. Once you're on a job assignment and the day that it becomes that you realize it's going to last more than a year, it is no longer a temporary job site. But driving between your home and a temporary job site is deductible, and then driving to job interviews, conferences, things like that. Commuting between your home, if you're not claiming the home office deduction, in a regular place of business is not tax deductible, but the locum tenens doesn't work like that. So all the mileage should be deductible between your home and this temporary job site for your position that will last a year or less. When you have your automobile expenses, there's two ways to claim the deduction. One way is you base it on the standard mileage rates. So for 2022, this should be 2022, sorry. For 2022, the first half of the year, the rate was 58.5 cents a mile. Then we started paying a real lot of money for gas, and they increased it to 62.5 cents a mile as of July 1st, 2022. For 2023, it increased even more. So the standard business mileage rate is 65.5 cents per mile in 2022. Let's say you did a locum tenens assignment the second half of 2022. I mean, it's 65.5 cents for 2023. Let's say you did 62.5 cents. Let's say you did a locum tenens assignment the second half of 2022. You drove 1,000 miles in connection with that locum tenens assignment. You would get the claim a deduction of $625 against your 1099 income for that mileage. It's nice and easy. The second way to claim your business expenses, your automobile expenses, is you base the deduction on actual expenses incurred. And actual expenses is gas, insurance, repairs, parking at home, lease payments if you lease your car, or a factor for depreciation if you own your car. And then you add up all these expenses, and then you divide it by the total miles driven, and you multiply it by business miles driven. Okay, so it's total expenses divided by total miles, gets your cost per mile times business miles. What I found over the years is, unless somebody drives very few miles during the year, and most of those miles are business miles, people are usually better off just basing their deduction on the standard mileage rate, which was 58.5 cents for the first half of 2022, 62.5% the second half, and this year it's going to be 65.5 cents per mile. Parking at home counts, that surprises people sometimes, but that's seen as a business expense. And parking and tolls in connection with work, driving to a job site and parking at a job site, those are not limited by either the standard mileage rates or by the percentage for the actual expenses incurred. Parking and tolls is fully deductible as an expense over and above the standard mileage rate, or over and above the actual expenses incurred. So somehow you want to keep track of your expenses. There's all these apps out there to keep track of a log. It's a good idea to keep a log if you'll be deducting business expenses. I mean, automobile expenses. All righty. Next up, we have education, licenses, and examinations. And for people doing locum tenens, this is very important because you probably have to credential or be licensed in each state where you work. I'm not sure who pays those fees, but if you pay those fees yourself, you're going to want to keep track of them. So the rules are very simple. So basically, anytime that you do something that qualifies you for a new trade or business, those expenses, the costs incurred with that would not be tax deductible. So medical school, getting your bachelor's degree, law school, any of those courses of study that qualify you for the minimum requirement in a profession, those education costs generally are not tax deductible. Once you reach that minimum threshold in a profession, then all your additional costs are deductible, and that includes relicensing, recredentialing, getting licensed in other states, potentially expanding your licensing if it's in the same field as you're currently in. So for instance, if anybody's a dentist, the dental specialty program actually is seen as deductible. That is enhancing your skill in the field of dentistry that is not qualifying you for a new trade of business. So general dentists can do orthodontics just as well. Well, I don't know as well, but just like an orthodontist can do it. So an orthodontist can just do it better because they've had 3 years of training. Anybody in mental health, the cost of psychoanalysis as part of the training to become a psychotherapist, that's deductible as a education expense. That's improving your skills in the current trade of business. So this part is a little bit flexible. We have people who are looking to go to underserved areas and they're studying a foreign language, Spanish or something like that. If you can prove that it's enhancing your skills in your current trade of business, that would be tax deductible against your 1099 income that you receive. Okay, so keep track of all those expenses, and then when it comes time to do your taxes, make sure to deduct them. And we have a slide on how to keep track of your expenses in a little bit. And lastly, I talked about this not really being an issue anymore. Section 139 reimbursement. So this was introduced. This was actually introduced back in September 11th, 2001, after that horrific event. And basically, Section 139 says in times where everything is turned upside down, certain expenses that would never be deductible because of personal in nature become deductible because you can't work without these expenses. And this came up again during COVID. So in 2020, we had clients who deducted 139 expenses. It was getting the house prepared to work from home. It was stuff to, being able to work remotely, paying a premium for your kids to be educated, cared for, things of that nature. That all would have qualified for 139. Happily, all this stuff is behind us. As I said, we're coming on 3 years from when all this craziness began. And so Section 139 is just, it's a throwback. It's just, I don't know. We had the slide. I think it's actually an interesting concept, but it's something that doesn't really affect us in 2022, and hopefully it won't affect us going forward. All right, here we go. But this next topic is very, very important. So when you work for a company, most companies have some type of retirement plan set up for their employees to help them save for retirement. Now, the golden day when companies used to have pension plans in place where people could work and they'd be guaranteed income for life, those don't really exist anymore in the private sector. And the government, the state and federal government, the state still does. I'm not sure about the federal government. So during your working years, it's up to you to try to save as much as you can to be able to retire comfortably and not worrying about running out of money. When you're self-employed or you work at locums, it's up to you to establish a plan and fund that plan each and every year based on the profits that you earn. But I want to show you why it works out to be so great. So, so when you save for retirement, unless you go into a version of the retirement plan, the Roth version that isn't tax deductible, when you save for retirement, every dollar you put into your retirement account saves you taxes. And those taxes that you save, that's the value. That's what makes these things so great. So let's say that you're in the 28% federal tax bracket and you're in the 5% state tax bracket. That means you're taxed at a combined 33% interest rate. So in this situation, when you contribute to a retirement plan, for every $1,000 that you put into the retirement plan, it only costs you $670 in after-tax dollars to put that money away, right? So you can either pay yourself $1,000, pay $330 to the government and keep $670, or you put the whole $1,000 into the retirement plan and you keep the whole $1,000. So you can either have $670 in your bank, or you can have $1,000 in your investment account growing tax deferred. So you've already earned $330 on the $670 that you invested. You've already earned a 44.25% return on your money. Now, where else can you get a 44.25% return on your money? Risk-free, guaranteed. Now, of course, you save the taxes now, you will pay taxes on your retirement account later. So what I'm saying isn't 100% true, but in the short term, you got your 44% return on your money, and you get to invest that $330. You get to put the $330 that would have otherwise gone to the government into your investment account, and you keep the compounded tax deferred earnings on all those $330 based on every $1,000 you put away for decades, for as long as the money is invested. The government gives you the money, you invest it, you keep the compounded earnings on that money. There is not a better way to see your nest egg grow than to save taxes by putting money into the account, and you invest the tax savings and you keep the money. I think that makes sense. And it really works. And the longer the money stays invested, the more powerful the compounded growth on the government's money is, and that is how you get ahead and save for retirement. So as I said, you are taxed on the distributions that you take down the road, but your first goal to yourself is to save enough money while you're working, during your working years, invest the money prudently, keep the after-tax earnings on that money, and be in a position when you're in your 60s or early 70s to be able to retire. Maybe you love doing locums and you want to do some of it every year. You want the ability, you want to have the option to retire. You don't want to, even if you don't want to retire, you know what I mean? Okay, so contributing to a retirement plan is one of the best ways to build a nest egg for your post-working years, during your working years. And we're not going to get too involved with this, but the most popular options for people who are self-employed are these things called SEP IRAs, simple IRAs, and solo 401ks. And we have a link and we have more information on that somewhere. But saving for retirement is the first and best thing to do. You save taxes now, but it gives you the financial peace of mind that you need. And if you ever read what they're posting on my phone feed, I don't know why I get all these articles. I think 60% of the country isn't saving any money for retirement, and they didn't even have any money to do anything now. Do yourself a favor, be in the other percentage of people who are in a position to be able to retire comfortably. All right, next up we have health savings accounts. Health savings accounts are another tax advantage way to build a nice nest egg. And if you're self-employed and you're getting your own health insurance, it's actually easier to arrange to be able to put money into a health savings account. So to be able to put money into a health savings account, you need to your health insurance. The health insurance you get needs to be a qualifying high deductible health insurance plan. And whoever you get the health insurance from will tell you whether or not the health insurance you have is a qualifying high deductible health insurance plan. If you do have one of these qualifying high deductible health insurance plans, then you're allowed to set up the second account called a health savings account, where it works just like a retirement account or a individual retirement account, an IRA. Every year, you're allowed to put money into the HSA every year that you have the high deductible plan. And there's no requirement that you take the money out during the year to spend on your family's medical expenses, healthcare expenses. So you can put money into this health savings account and you can leave it in there. Now, health savings accounts are the only account that I know of where the money that goes in is tax deductible and the money that comes out is tax free. Okay. So with retirement accounts, you either, if the money's tax deductible going in, you pay taxes when it comes out. Or if you do a Roth account, you forgo a current year tax break with those, and when the money comes out tax-free. Health savings accounts, the money that goes in is tax deductible, and the money that comes out that's used for your family's medical expenses is tax-free. And the whole time the money is invested, it grows tax deferred. I was reading something recently, and they said Fidelity Investments, which is up here in Boston, based in Boston, that is the best place now to put the HSA money. If you have a individual plan this year, you're able to put away $3,650 into your health savings account for 2022. You have until April 15th of 2023 to put the money in and still get the deduction for 2022. If you have a family plan, or if it's you with dependents, then you can put $7,300 into your health savings account this year. And next year, it's increasing to $7,750 for families and $3,850 for individuals. And I just want to repeat myself. This isn't like a flexible spending account, which you might have had at another job or which your spouse might currently have, where you can put away money every year and there's a lose it or use it component. So if you don't spend the money you put into the flexible spending account, you lose it. A health savings account, it's your money. It's an account that you can invest just like your retirement accounts and other accounts. Tax deductible money, grows tax deferred, comes out tax free. Great way to put in extra money. And if you have a health savings account and your family has a medical bill, at that point, you want to decide whether you want to take money out of your beautiful health savings account that's growing tax deferred, and you can take money out later that's going to come out tax free, or you want to take it out of money just sitting in your checking account that's earning no interest, that's just sitting there, blah, and doing nothing for you. So we have clients who put money into the health savings account every year, never take any money out. And at this point, they have 6 figures in the health savings account that's available, growing tax deferred, that can come out tax free later to pay their health expenses. And let me tell you something, I'm 57. As you get a little bit older, you're going to have health expenses, and no matter how healthy you are. Well, hopefully you won't, but most people are going to have plenty of opportunities to spend the money on their health expenses later. Okay. So if you're compensated as a locum tenens, you're going to get paid straight. You get paid as a 1099 contractor, not as a W-2 employee. So that means there's nobody withholding taxes to cover your tax bill next April. So it's up to you to pay in your own taxes. So most people who are paid as 1099 contractors, they're supposed to send in quarterly taxes each quarter. The quarters aren't actually every 3 months because the government is involved. The first quarter is April 15th for all the money you earned through March 31st. So that's actually a quarter. The second quarterly tax payment is due June 15th. So it only covers 2 months. It's through May 31st. And then you have September 15th, the third quarter. And the fourth quarter, you actually have all the way till January 15th of the following year to pay for all the money earned through December 31st. If your income is consistent year in and year out, then it's very easy to figure out your estimates. You base it on your prior year's tax. Otherwise, you have to kind of figure out every quarter how much you want to pay, and you send in the money to the IRS and to the state where you actually, we'll talk about the state tax issues in a few minutes. Okay, so it's not very difficult to pay estimated taxes. I pay estimated taxes every quarter. I actually just go to irs.gov. Let's see what this thing looks like. So they have some information, and I just pay it electronically. This day and age, the IRS is doing a little bit better, but they weren't so good at processing their mail because they had nobody working there for a while. I would recommend, if you're paying quarterly estimates, to pay it online. All righty. The QBI deduction, this started back in 2018. This is what Trump put into place. It is going to sunset at some point, but essentially it's a way for people who are self-employed, who make below a certain amount of money, to save some taxes. They pay less taxes on the self-employment income. And this QBI deduction, it applies to sole proprietors, partnerships, S corporations, and limited liability companies. For people who are in a healthcare business, the amount that they can claim for the QBI is dependent on how much income they earn. If their income's too high, they're not eligible for the QBI deduction. If their income's below the threshold, they get the full QBI deduction. So if you're single, if you earn less than $170,000, or if your taxable income is less than $170,000, you'll get the QBI deduction. And basically, the QBI deduction is you take your self-employed income and you multiply it by 20%, and that's a deduction against your income, and it reduces the income taxes that you pay. If you're married, the phase out starts at $340,000. So if you're married and your spouse doesn't work, or you're married and you're together, you're making less than $340,000, you get this nice deduction. So don't overlook the QBI deduction. It's been around for a few years. The tax software or your tax preparer will figure it out automatically as filing your tax return. Okay, so here's some planning tips. So when you work for somebody that withhold taxes, things are definitely much easier. If you're a locum and you get paid as a 1099 contractor, it is a little bit of a headache, but it's not that big of a deal. So the first thing we recommend is you follow the 40% rule. And we suggest that when you work locums, you set up a bank account to where you deposit your locums pay, and then you write all the expenses that you want to deduct out of that same bank account. We suggest you set up a companion savings account and you transfer 40% of your net income, the amount that you get paid less your expenses, to a separate savings account, and that's the money you're going to use to pay your taxes. If money accumulates in that account, expect to owe money. If somebody sets up estimated taxes for you and there's not enough money in the account after you put away 40% to pay the taxes, then you might be in a situation where you can pay lower estimates. But if you put away 40% of what you earn, you shouldn't be caught short and owe a lot of taxes. Out of the 40%, you want to submit your quarterly estimates. It's not that difficult to do. Go to irs.gov. You definitely want to track your professional expenses. So there's different ways to do it. The best way to do it is to use a personal finance program such as, here's another typo, but it's such as Quicken or Mint. I got to fix that. I think that probably had the same typo last year. Sorry. There you link up your bank account and your credit card with these two programs. It pulls in all the transactions. You classify it, or the program learns how to classify your expenses. And then you can print the profit and loss report at the end of the year, and it shows all the different business expenses that you want to write off against your 1099 contractor income. A separate bank account is a good idea. Some people don't want a separate bank account, but they use a separate credit card that gives a nice year-end report. If you can put all your expenses in connection with the locums through the dedicated credit card and use a separate credit card for all your personal expenses, that works fine. There's a spreadsheet linked to this that you can get from Barton, or you can just set up a folder and put in your receipts. That's actually not the best way to do it because you're not going to keep track of everything, but that's better than nothing. But keep good records, because every dollar that you can claim in expenses against your 1099 income, you're actually going to save about 45 cents in taxes. It's a big deal. Take advantage of the tax shelters we discussed. Those are the retirement accounts and the HSAs. They're both great ways to save some taxes. And if you're locums, you can do your own taxes. If you go to a tax firm that deals with a lot of healthcare professionals, you might find it helpful. They might be able to help you maximize your deductions, make sure you're not missing out on anything, or make sure you're maximizing the amount of money going into these pre-tax savings opportunities, which long-term just work out great. Okay, a few more things to touch on. The state tax issue. It's very interesting how it works. But the bottom line is, you do not get taxed twice on the income. So you first pay income taxes to the state where you work. So if you work in a state that has an income tax, expect to owe taxes to that state. So if you, in New England, if you live in Massachusetts, if you work in Rhode Island, you would first pay Rhode Island taxes on that income. Next, you calculate the tax based on you calculate the tax in the state where you live based on the income you earn. So in Massachusetts, it's nice and easy. The tax rate's 5%. So let's say you earn $100,000. The mass tax would be $5,000, but there's no double taxation. We would take a look at the amount of taxes paid to Rhode Island, and any taxes paid to Rhode Island offset on that income, offset the taxes I'll pay to Mass on that income. Now, Rhode Island has a higher tax rate than Massachusetts generally. So the Rhode Island taxes paid will completely offset the Mass taxes paid. So in this situation, I would only owe taxes to Rhode Island on that income. I wouldn't owe taxes to Mass. The way it ends up working is between both states, you pay taxes based on the state with a higher rate. So if you live in a state with no tax, you pay tax on the state where you work. If you live in a state with a tax lower than the state where you work, you pay taxes based on the state where you work, and you don't pay any taxes to the state where you live. And if you live in a high tax state, you first pay taxes on the state you work, and then you pay the difference on based on the pay difference on in the state where you live. You know what I mean? But you end up paying based on the higher rate. And last but not least, I just want to touch on S corporations. So S corporations are great. S corporations do allow you to save some taxes. There's a way that you pay yourself where you avoid paying Medicare taxes. If your income is low enough, you also avoid paying Social Security taxes. Most states now let you get around the thing that Trump put into place in 2018, the state and local tax limitation, which caps your real estate taxes and your state income taxes at $10,000. So both of those things are very good. The rule of thumb we have in our office, though, there are a lot of costs and fees associated with incorporating as an S corporation. So we would generally say, unless your net income is going to exceed about $350,000, believe it or not, you might be better off just remaining self-employed. There's always variables in different situations, so you have to figure out what applies best to you. But when people start making more than $350,000, $400,000, we have them, if they're operating as an LLC, we have the LLC elect to be treated as an S corporation. Now, if you're locum tenens professional, there's a lot of pitfalls with operating as an S corporation, from what I understand. The first is, if you have an S corporation, that S corporation is supposed to register in every state where it works. So if you're going to travel around and work in different states, that's just, it's a headache, it's a hassle. Your S corporation needs to register as a non-resident corporation in each state. And then when you pay yourself as a W-2 employee of your S corporation, you're supposed to set up to withhold taxes and do unemployment taxes for each state where you work. That's my understanding, or that's the most conservative way to approach it. It just seems like an S corporation for someone doing locums who's going to travel around a lot, it's just going to be an administrative nightmare to do it right. Chances are, if you don't do it right, it's unlikely that it'll be an issue, but that's not the way to do it. So I'm not so gung-ho on people who are doing locums to immediately set up an S corporation. All right, but look at the same thing here. You definitely want to consult a tax professional before you do anything. The rules are complicated. Setting up entities, it's expensive to set up. Administratively, it's a headache to maintain these entities, and they're expensive to maintain. I think that's what. So that's what I had. So we'll go through these questions. Let's see how many we can get through in the next 10 minutes. We'll do the speed round. Okay. But I hope you found it informative. So we talked about the PPP loan, liability insurance deductible. Yeah, if you have to pay your own malpractice insurance, that would definitely count as a deductible business expense. That's definitely ordinary and necessary. You probably shouldn't be practicing without liability insurance. Liability on your car, your automobile insurance, that would be an automobile expense. And life and disability insurance, those are generally never tax deductible, but they're not taxable when you receive them, when you do receive them. Okay, can you give details for auto expenses, automobile expenses, what's deductible? We did talk about that, but there's a whole list here. Where do we go here? Okay, so it's these things right here: gas, insurance, repairs, parking at home, lease payment if you lease your car, and a factor for depreciation if you own a car. Is business travel tickets tax deductible as opposed to economy tickets? Any money you spend on travel in connection with a locum tenens position, as long as it's an assignment that's going to last a year or less, and you're traveling far enough away that you would have to rest before coming home, the money you spend for the tickets is deductible. If you have comp tickets, if you turn in miles to get tickets, there is no cost associated with that, so that wouldn't be tax deductible. Medical supplies. Whoop. What happened here? Medical supplies. Oops, we went to the bottom. Sorry about that. We saw it. We saw it. Okay, here we go. Medical supplies, deductible. Yes, definitely. Ordinary and necessary. If you need it to do your job, it's deductible. Clothing that you can wear outside, that isn't tax deductible. Clothing is, that's not. Dry cleaning. If you dry clean lab coats and scrubs, I guess you wouldn't dry clean. That would be deductible. Dry cleaning regular clothes that you can wear out is not deductible. What if I have a family health insurance plan that I pay for not through a spouse? How much can I count for me? If you have health insurance for your family, you count the whole thing. It's all deductible. So 100% of the premium is deductible. If you have if you're an individual, it's your single premium. If you're have a family plan, it's a family plan premium. Is this going to screw up on me? Is your spouse's Medicare premiums deductible? I think the stance it is, and I think I'm right about that. So your Medicare premiums and your spouse's Medicare premiums are both deductible, yes. Is disability insurance deductible? Disability insurance is definitely is usually not tax deductible. So when you pay disability insurance premiums, those premiums aren't deductible. But if you need to collect disability later, the benefit is tax-free to you. So it works out pretty good. So most people, they get enough disability insurance to replace 60% of their income. Because it comes tax-free, it's that 60% is enough to cover what you need to do. What about supplemental health? I think that would count. Medicare premium, yep. If a company gives a 1099 for the expenses they reimburse, can you claim them since they're putting it as income? Yes. So if you get a 1099, let's say you make $100,000 as locums, and then you have a $20,000 of housing that they pay on your behalf, and they give you a 1099 for $120,000, you would definitely claim $20,000 as an expense. We categorize it on the tax return, not as travel. We would put that on the Schedule C, the place that on your tax return where you report it as reimbursed expenses included in the 1099. You only want to pay taxes on the income you actually earn, not the money that they paid you. Can umbrella insurance policy be deductible? I would say a business umbrella could be. Personal umbrella, probably not. Personal umbrella, yeah, covers expenses that wouldn't be deductible expenses. COBRA. So COBRA is one of these things. I think if you read the rules, I actually think it says no. But if you make a business decision and the best insurance that you can get for the best premium is by taking COBRA for 18 months, I would say it would be deductible because you're buying your own health insurance and you're buying it for the best possible price. So we do deduct COBRA insurance here. And I use that rationale. It would be more expensive to buy it elsewhere. If I was reimbursed on a daily stipend, is this the same question? In my 1099, can I deduct the lodging I paid for myself? Yeah, that's the same question. Meals include restaurant and groceries. Yes. So meals, it's MIE. So it's meals and incidentals. So that does include restaurant and groceries. But don't forget, with the meals, you either take the standard mileage rate, you take the per diem rate, which you can get at gsa.gov, right? Remember that nifty link that we put here? Wherever it is. Yeah, it's here somewhere. Here it is, gsa.gov, or you base it by the trip on the total expenses that you incurred. Are the per diem meals deductible only for days you're working? No, they're deductible for the whole time you're away, because it's all a business trip. So if it's domestic travel, the rule is it has to be primarily for business. So it has to be more time spent on business than not business. If it's international travel, then the rules are it's a higher threshold. The trip has to be exclusively for business. Now, travel days and weekend days that touch a working day, they count as being days on the trip. But if you finish your per diem on Wednesday and then Thursday, Friday, you stay there traveling and you're abroad, that actually doesn't count as business days. Do travel days count? Yeah, I would say so.
A lot of these questions you actually answered last year as well. So the good thing is I'll be able to send out a link to the FAQs from last year, okay, along with this presentation. And if there's still additional questions, you guys can feel free to reach out to me, or I'm sure, Andrew has a team that would love to talk to you about your tax needs. So this will be posted online. You'll get an email with it. Just please give us a little bit of time to edit the video, cut out the beginning of it. But it'll be available everywhere on our website. Andrew will also have it on his website. It will be very readily available for you guys. And do you have anything else to say, Andrew? I just want to make sure it doesn't get cut off.
Yeah, I think do I have my contact information? Oh, well, here's my email address. And so we do get calls from people who participated in the webinar. And if you do, there's a CPA at my firm named Ike Braden, and he's been handling a lot of the Locum Tenens work that we're bringing in, and Ike's very knowledgeable. And so if you call and you get referred to this guy named Ike, he works with me, very knowledgeable about this. He's been working with dozens and dozens of locums people. So we do want to be a good resource, but if you have questions between what Stacy just said, between the Q&A from last year that we did, and if you have other questions, we want to be a good resource. And I appreciate this opportunity every year to present this information to the people who work through Barton. So thank you, Stacy.
Of course, and thank you so much, Andrew, and thank you to everyone who joined us today, and for all the work you guys do to help keep us healthy and safe. And again, I will be sending out a ton of information, so all of this will be recorded, and you'll have, you know, everything that Andrew said will be recorded. So thank you again, everyone, and I hope to see you next year.